Good evening, ladies and gentlemen, and welcome to our class on chart patterns and interpretations, sponsored by UBCFX, one of the world's leading providers of CFD and Forex trading. There's many reasons to trade with UBCFX, everything from their VIP card to their innovative trading platforms to their free accounts. Okay. They offer 4 different trading platforms, over 120 different trading instruments, and spreads as little as 0 pips. You can use their Cerex web trader. You can use their Active 8 trader. You can use their download their Cerex station, or of course their mobile trader. They have trading platforms fit your type of trading. Fits all your needs. They have trading tools, special accounts, super signals, excellent education, a variety of platforms, and many different payment methods. And you choose the account that best fits your needs. There's no charge for any account, and you can take whichever one you like or step up to their exclusive VIP accounts. Now, UBCFX is a regulated provider, so I'm therefore required to give you a risk warning, and then we'll get started on our webinar tonight. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risk or seek independent advice if necessary. UBCFX provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only. And if you want, you can go to www.ubcfx.com and open up a demo account and take advantage of their broad education center. Now, tonight's class is being recorded. If you want to see a recorded version of this class, you can use the same link you used to attend tonight's class in about 24 hours and see an unedited version of this class. Or you can wait a while and then you can go to www.investing.com where you signed up for the webinar and go under the education tab and then look for webinars on demand. And there you can find all the classes we've ever given in a recorded format. And you can choose and pick which ones you want to see. Now, also tonight, I'm going to be sharing with you a couple short presentations that are pre-prepared for you. And you can also see these if you want at the link that I'm about to pop up on your screen. And just look under support and resistance in the playlist. And under chart patterns in the playlist. And you can see these presentations. You can also see there are a lot of other bits and pieces we've done on presentations for our webinars. Also, if you look on your screen, you can see that I prepared 2 handouts for you. You need to download these now. They are not available in any other time or any other method. They're only available during the live class. So please download them to whatever device you're using, and then you can move them to where you want. But I've given you a guide that covers basically all of that we're going over in class tonight. And so that way you can keep yourself refreshed. And I've also given you the investing.com's introduction to technical analysis. It will cover everything from chart patterns to trend lines to all about the beginnings of technical analysis. So download those now onto your from your screen, and then you can read them later to help you remember what you saw in tonight's class. And remember, again, they are only available in the live class. Now tonight, when we're talking about chart patterns, I might use the word security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, cryptocurrencies, CFDs, mutual funds, options. Now, while I may imply a specific investment product, for example, I may say shares, or I may say Forex, it's just that it gets very, very, very boring saying security, security, security. So I kind of mix and match, but you know what I'm talking about. I'm just talking about any of the tradable instruments. Similarly, I intermix the term investing and trading. And I mention this because I've gotten lots of unkind emails over the years about, well, you keep saying investing, I'm a trader, or you keep saying this works for trading, but I'm an investor. The fact is, these concepts work equally well for short-term traders or long-term investors. And I understand the difference, but it gets boring just saying trader, 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 and sometimes I like to say investing. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. In either case, the basic concepts and techniques presented in this class are equally adept. Now, we all try to get out of technical analysis some important information. We also have some misconceptions about it. So the main question about anything is, should I buy today? What will the prices be tomorrow, next week, or even later on in an hour or two? Wouldn't investing be easy if we knew the answers to these seemingly simple questions? But alas, I don't have a Ouija board or a crystal ball, so I don't have the answers to these. If you're attending tonight's class in the hopes that technical analysis will answer these questions, I'm afraid I have to disappoint you. It doesn't. However, if you're attending tonight's class in the hopes that technical analysis will improve your investing and trading, I have good news for you. That's exactly what it will do. So let's get on talking about chart patterns and interpretations. Now, technical analysis and chart patterns fall in the area of technical analysis. Because technical analysis refers to the study of financial markets based on price movement. It uses the assumption that price of a share reflects all information about that share, including market sentiment as well as its perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in share prices. For example, head and shoulders, channels, triangles, and wedges. Now, it all comes down to is all technical analysis is done on a price chart. We can do technical analysis through indicators, and that's what most of us just assume are the whole field of technical analysis, which are oscillators like RSI and stochastics or MACD or CCI or Williams percent R. But the fact is, anything we do on a chart falls into the area of technical analysis. And chart patterns is one of the largest areas of technical analysis, one of the biggest sectors, and surprisingly, it's one of the most well-known and well-used parts of technical analysis. Chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments and liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of an asset as it breaks key psychological barriers in the form of support and resistance lines. There are numerous types of patterns, all named according to the shapes that they do on the graph between the support and resistance lines. These include triangles, which are the most important and the most well-known, channels, wedges, head and shoulders patterns. We also have things called teacups. We have bearish flags and bullish flags, pennants. There's tons of them out there. But a triangle is the most important. Okay. And before we actually talk about triangle, I'm going to pop you up. I think I have the chart ready for us. Okay. See, here is a beautiful triangle formed on Bitcoin. And what we can see is price broke out and broke down just today, because as price is pushed into the apex of the triangle, and this triangle has been on this chart for quite some time, and as price is pushed farther and farther into this apex, sooner or later it has to break out. Now, based on some other assumptions that we have, there was a 45% chance it would break up and a 55% chance it would break down. Now, today we had some significant action in the market, and Bitcoin took a big tumble. But we can see Bitcoin broke out below that triangle. At any time it breaks, whether it's above or below, it's called a breakout. Now, it can break up or it can break down. Now, there's also standard calculations that we can apply to the momentum of where we expect this breakout, in this case to break down, to go to. And we're going to talk about those and look at how you can use the width of the triangle to determine the momentum and how far to project that price should move when it does break out. So But here we have a nice triangle. Okay. Let's see. I think I have another chart up here for you with. Okay. Here we have a descending triangle, and we also have a falling wedge directly on the charts. And we can use these to interpret where we expect price to go. But as I said, chart patterns are one of the most well-respected tools that are used by traders. Here we have a upward channel. Okay, so let's talk about what all these are. Let's go back to my PowerPoint. Okay. Now, a triangle is formed between converging support and resistance lines. We have a negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the value of an asset. With a positive sloping support line, prices are squeezed into a corner. Once the support or resistance line is broken, pressure that is built up as a result of uncertainty is released and a certain amount of momentum is added to the price change in the direction of the breakout. Now, there are specific variations of a triangle that can occur, namely an ascending, a descending, or an ascending or a descending triangle. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. And I'm going to show you this in the presentation in a moment. An ascending triangle usually occurs as a continuation of a bullish trend, while a descending triangle occurs as a continuation of a bearish trend. It's important to note that an ascending triangle can also be found in a downtrend. So the financial asset needs to test the resistance level twice, and the asset closing price needs to be higher than the previous close. In other words, the closing price has to follow the rising trend line. Next, we come to volume. Volume is one of your key pieces of information because as price moves into these corners or into these apexes to get ready to break out, we would like to see volume staying steady at the time of the breakout because price can ease above or below one of those lines. But we should see volume increasing as it breaks out, and that's what gives us the momentum. When in an ascending triangle, volume usually contracts, although there are a few number of cases that show volume has not contracted, but the pattern has been displayed. This has been signified by the blue line on the bottom of our charts. Now, rectangles, from triangles, we go to rectangles and channels. Then from there, we go to wedges. And there's all types. To me, wedges, are simply a variation of a triangle. They have sloping support and resistance lines. And then rectangles and channels have support and resistance lines that don't come together. They just form a boundary above and below. But triangles are the most significant and most important. So let me share a little presentation with you. And then we'll continue on talking about triangle and how to start using these actually in your trading strategies and use them for entry points, exit points, target points. Okay, how to judge momentum. We'll talk about that all shortly. So as you can see, triangles are quite simple. Recognizing them is a little bit time consuming, and there's actually now scanners and indicators out there that will actually tell you when they're developing and where they are on your charts. One of the more popular and well-known trend patterns is called a head and shoulders pattern. Now, a head and shoulders pattern is exactly as the name implies. It's a pattern. Uh-oh. Hold on one second. My screen's going a little berserky here. A head and shoulders pattern is exactly as it's named. It's a price forms a left shoulder, a neckline, a head, and reaches the neckline again, forms the right shoulder, and then down to the neckline. It's just like a person, a human being. You have a left shoulder and a right shoulder. Now, they're usually, for most of us, equal distance and equal levels, but some people have, lean to the left, lean to the right. Some people have a higher or lower shoulder. So the two shoulders and a head and shoulders do not have to be the exact specific price level, but they should be close to it, just like a human being. Okay, a human shoulders. You may, like I said, you may be leaned a little left or leaned a little right. Okay, or higher or lower, but same thing with the head. There's all types of formulas and gurus out there teaching you how much the head has to exceed the shoulders to form the head to actually be a head and shoulders. But the fact is, as long as the head, which is here, this high, is higher than the shoulders, it's a head and shoulders pattern. Because sometimes you have people with long necks and short necks, you have people that are hunchback, you have anything. So as long as you have the two shoulders and the head, you have a head and shoulders pattern. Now, a head and shoulders pattern takes a while to develop, and you really won't recognize it until it's almost at this point here. Because as price is moving up, it hits a resistance line or hits a peak and then comes back down to a support line, bounces off of it, and goes higher than the previous support level, and moves back up and hits a new resistance level higher, but comes down, and this is crucial, comes down and forms that bounce off that same support line, which forms or becomes the neckline. Okay, so this is what joins the two shoulders together. Okay. It bounces off that neckline, but we still don't even really have to make any preparation for that head and shoulders pattern. Hold on a second, let me get these. Until we get to the formation of the right shoulder. Okay. Once we have price move back up here and it bounces off of that same resistance level, it starts moving down to that neckline again, we then have a head and shoulders, and we should then be planning for our trading ahead, because a head and shoulders pattern, a developed head and shoulder pattern, will offer us an opportunity to short that asset. We have an inverse head and shoulders with the exact opposite, because an inverse head and shoulders forms as part of a downtrend and then will give us a buy opportunity to buy. A head and shoulders pattern describes a price movement that depicts a head and shoulders of a person. Head and shoulders is a reversal pattern from a bullish trend to a bearish trend. The pattern starts when the graph crosses the support line upward before formation of the left shoulder and is completed once the graph crosses the shoulder line downward after the formation of the right shoulder. The popular head and shoulder pattern is essentially a triple top pattern, except that instead of all peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the amount of bearish pullback that should occur between tops, with some allowing for 10%, some 15%. I say it's all bull. All I want to see is the formation of the head and the shoulders. Now, signal strength is bolstered by an agreement from other indicators, such as waning volume, as the trend nears exhaustion. Because a head and shoulders pattern needs to form in a trend. Now, the fact is, even on my chart, on my diagram here, it's really pretty and easy to see, and it looks just like I said it would. But in reality, on a price chart, it's very hard to spot, okay? Because price is moving all over the place. And that's why you won't, like I said, you won't even see it until it's got its final formation. Price moved up to form the left shoulder. You would have not known it at this point. You saw price moving up and bounce off resistance level, but had no idea it was forming a shoulder. Came back down to the resistance level, the support level, bounced off of there, bounced up, became higher than the previous resistance, broke through the resistance level here, and moved up to form what will be the head. Okay. It came down to the resistance level, the support level, and at this point formed a neckline. It then eventually moved back up to that same resistance level and bounced off of it. At this point, it is now making that right shoulder. It moves down, and when it breaks through this neckline, it offers us a shorting opportunity. But the fact is, it's not, when I draw my lines on it, it looks like that little pattern, but spotting it in real life isn't so easy. Now, there's a formula to calculate the target price, because you need to be able to figure the target price, or where price should go. Basically, it would be your entry point, because you need to be able to calculate your target price so that you can come up with your risk, profit, and reward scenario, or your risk management tools, to see if it can make and where you would want to set your exit strategy. And this formula is simply T minus N minus H minus N, which is the target price is the neckline minus the headline minus the neck. So if we were to say hypothetically that the neckline was formed to, say, for mathematical purposes, say at 100. The head was at 125. And I'm just making up these numbers. So we have our head and we have our neckline. Okay. If we were to take the difference between the neckline and the head, that would give us our H. So the difference is, that we would take the headline minus the neckline, and that would give us our number right here. So the headline is 125 minus 100, which would give us 25. The target point would then be T is equal to the neckline, which is 100, minus the 25, or 75. So that would give us our neckline at that level. That would give us our target price at that level. So we would set our take profit point there, and we'd also use this for our calculation of our profit reward ratio. Our sell signal, our transaction signal to sell, would come when the right shoulder broke below the neckline and stayed below the neckline. You want to give it a second to make sure it doesn't bounce, see, because here it bounced down, bounced back in a little bit, and then finally moved downward. Okay, because price, we have our highs and our lows and our closes. We have an inverse head and shoulders, which is the exact opposite, because one occurs in a downtrend, one occurs in an uptrend. From there, we also go on to very well-known patterns, which are multiple tops and multiple bottoms. Okay. A multiple top pattern occurs in an ongoing uptrend and indicates that the trend is near exhaustion. If a security repeatedly has difficulty surpassing a certain price point, a multiple top pattern may form. As the bullish trend progresses, bulls repeatedly attempt and fail to push price forward. And what do we call these? We call these double tops and double bottoms. They're very easy to spot. Price moves up, hits a specific, whatever price it is, hits it, can't break through it, and it forms a resistance level, comes back down to its support level, bounces back up trying to reach and break above that resistance level that we just got from where it was here, and can't, and violates and bounces back down. Okay. This is a reversal pattern. But the fact is a double top and a double bottom happen continuously, and to me they offer no trading clues and no trading information, especially when we're talking Forex, because it's just the vibration of the markets. Now, if you're looking at longer term time frames, you're looking at a weekly or monthly, they have a little bit more validity. But from here we go to triple tops and triple bottoms. These I rely on a great deal. A triple top or triple bottom is the same reversal pattern, except they touch that support or resistance level 3 times. So in other words, if price was moving up and hit a resistance, bounce off, came back down, formed that support line, bounced back up, couldn't break that resistance line again, came back down, bounced up. Well, that's makes this is a very, very significant level, and price is having a very bad time bouncing. And then if it comes down to that support level and breaks through it, that's told you that that trend, the previous uptrend, is over. Reverse happens in a downtrend, and we have a triple bottom then. So a triple top is a price pattern which is formed in an uptrend and is followed by a drop in prices. A triple bottom is the exact opposite. And you have a standard calculation. Now, you don't have to write this down. It's in that handout I gave you. Okay, but here we have T equals R plus H, which is the difference between the resistance level and the support level, and that gives you your target or your momentum. Now, it's important. You see these patterns form, but it's important to look at the trend, not the trend line, but the trend. Because the better the quality of the trend, the more valid and the more apt that pattern will be significant. Because we can have trends that are wobble all over the place and have that aren't really well developed. There's still an uptrend, and a triangle develops or a wedge develops. But the more consistency we have to the trend and the more consistency we have to the movement, the more significant the significance we can put to that chart pattern. Now, a pattern is said to break out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it's called a continuation pattern. If it breaks out in the opposite direction, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that it is a bullish signal. That is, the breakout was through the resistance line upward. Because it's a reversal pattern, that means the preceding trend was in the opposite direction of the breakout. That is, the preceding trend was bearish. So there are simple formulas for judging the target level, the entry point, and the stop loss, or where to place your stop loss, with all of these patterns based on the support and resistance lines that are forming those patterns. So I'm going to share with you a presentation that's going to show you how to use these formations to set your target, your take profit points, and your stop loss points. So I hope that helped you understand and see how to use the momentum or the width of the triangle to figure out the momentum, as well as how to set your stop loss and take profit points. Now I'm going to pop up on your screen again the link, and if you just click on that, if you want to see that little presentation again, or the earlier one on triangles, click on that link and that'll take you to a playlist and look under chart patterns, and you'll see all the little presentations for chart patterns there. If you want to see this class, use the link you used to come to the night's class, but it won't be there for about 24 hours. Okay. And also, everything that we've talked about in this class tonight, as well as what's been in the presentations, are delineated for you in the handout I gave you called A Guide to Chart Patterns. And then for more information, you can read the Introduction to Technical Analysis. But please make sure you download those now because you won't have access to them again. And then on that note, I'm going to say goodnight to everybody, wish you some successful trading. And if you go to www.ubcfx, they will help you.com, set up a demo account, and you can contact a financial analyst there that'll explain these chart patterns to you one-on-one. They're there to help you understand everything you need and to help support you in your trading. So again, go to www.ubcfx.com. And if you can't access their platform from where you're home, from where you are, it means because they're a regulated provider and they only provide services in countries in which they are regulated. So thank you very much for joining us this evening. I hope you learned a little bit of something. Chart patterns, especially triangles, are very beneficial in your trading. I trade from chart patterns. And believe me, they're one of the things I rely on the most. So add them into your daily trading, start recognizing them on the charts, and in no time at all, you'll be able to find them easily. Thank you very much and have a great trading week. Bye now.